Our next guest is bullish on the market despite global uncertainty. For a closer look at why, joining us now is Diana Avigdor, portfolio manager and head of trading at Barometer Capital Management. Diana, good to be with you today. Thanks so much for joining us.
Thank you.
Hi. You know, we keep seeing this momentum, this grind higher, hitting new record highs in some cases, and yet earnings are just better than feared and better than low expectations. So how do you make the bullish case?
I think in the sea of headline risk that we've experienced in the last few months, where the market has continued to have some investment themes that are getting lost in the macro narrative. You see Microsoft today. The theory of its development into cloud has panned out. Earnings in terms of the financials, the big fear that it was going to be so horrible did not pan out. Markets tend to price in things. As you know, we spoke before the Brexit. It did not come down. The financials have not performed very well. Fixed income in the bank earnings have come in much better than expected. We understand why. There was lots of Brexit trading and so forth. There is so much pessimism, yet the headline risks are being digested one after the other. The economic surprises, the data that's coming in is better than expected. We are in a zero-rate environment, and the equity market is paying you a hefty premium to take on some risk. And not all of the risk in the market is so high that you cannot stomach investing in it. Some of the utilities, some of the bond proxies for sure have rallied so much because of money that's been flowing into it in the hopes and need of seeking yield. But some of the technology and industrials are also doing well. There are selected names in healthcare, like you mentioned, the Intuit Surgical, plays into Medtronic, which we hold one of our top 10. There are themes that are working in the market that will work regardless of the sea of headline risk that we get globally on the macro perspective. And the economic data in North America is coming in better than expected. So all is not lost yet.
Diana, I know that you mentioned in your note to us that, as a trader, you see that factor investing is all the rage in recent months. Can you tell us what you're seeing in terms of this factor investing, what that actually means? Is it not fundamental investing?
So different factors. So things like low momentum or high momentum or low volatility. And so there's all these metrics that are picked out, and a sea of stock being sent through computerized mathematical software that picks out a portfolio that fits particular factor metrics that are picked out and deemed as the mandate of that fund, quantitative fund.
Okay, right. So we're talking about quantitative funds.
Right.
Okay.
So quantitative could be, high momentum being a certain level of earnings growth, or low momentum, it goes utilities, or volatility. So they measure the volatility relative to some benchmark. But needless to say, these funds and the type of trading that derives from these funds tend to be price insensitive. They're factor sensitive, but they're price insensitive. So if the model, for example, drifts from its mandated name, it tends to trade for a portfolio, which is a basket of stocks, and brings the factors back in line. Whether it moves the stocks a little bit more than somebody who's price sensitive with a limit would.
Okay.
And I think to that extent, in low volume summer months, it can increase intraday volatility or intrastock volatility. Now, a lot of money has moved into low volatility factors. And one trader at RBC yesterday put out a note, which I thought was fantastic, saying that there is factor drift. So the low risk money has now become the crowded trade. And from the perspective of market sloppiness, this could derail the quiet. It becomes people who invest in a low vol product, don't expect high volatility. And when it happens,
yeah, but it'll become that way because it's the overcrowded consensus trade.
Right. So it becomes momentum.
Right. So tell me what area. Right. What areas are those? Because that's probably what we might want to avoid right now.
But no, not necessarily. I think that what it does, it creates opportunities should that trade, should that product get some money flowing out into some more growthy sectors. So from our perspective at Barometer, we barbelled the portfolios from defensive, utility-like bond proxy. We have income. We have clients that want income, to the more growthy, economically sensitive industrials, some financials, fintech, technology like Texas Instruments and Microsoft, Lockheed Martin, Honeywell, that sort of thing.
Dan, yeah, I just want to ask last question because I think this is important as well. Yeah. Henry Kravis, KKR, said that this market is not one for amateurs. You say what to that? Because it sounds like you're saying, look, be really careful in the fundamentals. There are opportunities, but don't just buy the market broadly. That's what I'm hearing.
Stock market is never for amateurs. You always have to do your homework, and there's so many different ways to make money. This is ours. But you always, no matter what your discipline is, and you should have discipline, you should always do so much homework, in my opinion.
All right, we'll leave it there. Dana, great to see you. Thank you very much.
Thank you, Catherine.
Thank you.